This lesson takes a look at a SPA3 investor portfolio using IJH, comparing the performance of a timing-based strategy with that of a buy and hold strategy over an 18.5-year time frame. Just a reminder that the content of today's lesson is purely for educational purposes and is not to be construed as financial advice. So here we have a chart of IJH since it was first listed in around 2000. You can see its performance over 18.5 years, and quite glaringly obvious in the middle of the chart is the GFC period. So what I've done is selected 6 separate 3-year periods that represent different types of markets. That's followed by a steadily uptrending 3-year period. That's followed by a 3-year period in which the market enters a significant correction. The next 3-year period is the period from the beginning of a full-scale bear market and the ensuing recovery. The next 3-year period is a steadily rising, low volatile market, and that's followed ultimately by a steadily rising but much higher volatility market over the last 3 years. And then we'll have a look at the entire 18-year period. So let's break down each one of these 3-year periods and see what we can learn. So let's have a look at how the performance of a buy and hold strategy compared with the use of the timing signals, that is the red and green arrows on the chart. You can see that starting off with $100,000, the blue line represents the timing-based strategy. So even though the market went sideways, we actually saw over the 3-year period a considerable amount of growth in the portfolio. Every time the equity curve has gone flat, that's when the portfolio has been invested in cash. There's no corresponding flat period in the buy and hold because it's always invested in the market. So whatever the market delivers, that's going to be reflected in the value of the portfolio. So we can see that even when the market went sideways, the timing-based portfolio was able to grow. In fact, over the first year, the timing-based portfolio put on a small return of 3%. The buy and hold, however, experienced a minus 19.6% return. In the second year, the timing grew another 8%, and the buy and hold had a small decline of minus 1.19%. In the third year, the buy and hold started to improve its performance as the market picked up, returning 24.16%, and the timing-based portfolio adding 20.77%. So over the 3 years, the timing-based portfolio, remembering this is in a sideways market, returned 34.34% over the 3 years. The buy and hold actually went backwards by a small degree by minus 1.35%. What about drawdown? Over the 3 years, the maximum drawdown for the timing-based portfolio was only minus 11.39%. The buy and hold, however, experienced a maximum drawdown of minus 31.85. So from that point of view, the timing wins in terms of the total returns, and it also had a much lower drawdown than the buy and hold strategy. So let's look at the next 3-year period. In this case, we're looking at a strong rising market from 2004 to 2007. And again, you can see the entry and exit signals on the chart. Here's the equity curve of employing a buy and hold strategy versus that of timing. Again, the blue line is the timing strategy and the orange line is the buy and hold. So you can see through 2004 to 2005, the timing strategy put on 9.61%, the buy and hold putting on 14.63%. In the second year, the timing put on 12.4%, buy and hold putting on 15.99%, and in the final year of that 3 years, the timing putting on 8.97% and buy and hold 17.94%. Again, you can see the flat sections in the timing-based portfolio showing when the portfolio was in cash. Over the 3-year time frame, the total returns, timing portfolio put on 33.28%, and the buy and hold portfolio grew by 56.82% over the entire 3 years. In terms of the drawdown, the timing-based portfolio experienced a maximum drawdown of minus 6.44%, whereas the buy and hold experienced a drawdown of minus 12.57%. So performance-wise, certainly buy and hold on this occasion, this 3-year period, outperformed the use of timing by quite a substantial amount. However, the timing-based strategy once again experienced a much smaller level of drawdown. Let's have a look at the next 3-year period. This is a period that's pre-GFC, so it's the last 18 months of a rising market and then the subsequent fall as we enter the GFC. So the market conditions are changing. Once again, starting off 2 portfolios with $100,000, we can see the equity curves as the years progress. The blue line representing timing and the orange buy and hold. You can see that as the market starts to enter the GFC, the significant bear period, there's a significant dip in the orange line, that is the buy and hold. During that time, very noticeably, the blue line, that's the timing-based strategy, is flat. So in the first year, you can see that the timing-based strategy grew the portfolio by 6.18%, buy and hold slightly above that, returning 7.38%. In the second year, the timing strategy experienced a loss of minus 11.48%. The buy and hold experienced a loss of minus 4.85%. But during the third year, in the middle of the GFC, the timing-based strategy actually grew the portfolio. Its portfolio experienced a return of 7.59% over that year, whereas the buy and hold experienced a 41.8% loss. So what does it look like over that 3-year time frame? The total returns from timing was 1.29%, that's positive, whereas the buy and hold returns was minus 40.8%. And that's one of the reasons why people are so scared of large bear markets using a buy and hold strategy. In terms of maximum drawdown, the timing-based portfolio experienced a minus 22.72% drawdown, whereas the buy and hold experienced a massive 56.6% drawdown. Now, when you're going through those sorts of drawdowns, it really does feel like the financial world is ending, such as the fear that investors feel at that time. So in terms of total returns, the winner this time is timing, putting on a positive return over those 3-year periods. And in terms of maximum drawdown, once again, timing is the winner there by experiencing a much smaller drawdown compared to buy and hold. Let's have a look at the next 3-year period. You can see the significant dip that we experienced in the middle of the GFC and then the ensuing rise. 2 portfolios, again starting off at $100,000, and you can see the flat blue line representing the period when the timing-based portfolio was sitting in cash. The orange line experiencing an ongoing drawdown right throughout 2008 and into early 2009. So over the first of those 3-year periods, 2007 to 2008, the timing-based portfolio experienced a minus 7.33% return. The buy and hold strategy experienced a minus 37.12% return. In the second year, both portfolios started to recover. The timing-based strategy produced a 38.87% gain and the buy and hold a 38.55% gain. So both portfolios performing really well. In 2009 to 2010, the timing-based strategy gained 26.4% and the buy and hold 25.38%. So again, very similar performance returns. In terms of the 3-year total returns, the timing-based strategy grew a portfolio by 17.82%, whereas the buy and hold experienced just a 3.3% over that 3-year time frame. As far as maximum drawdown, in the timing-based portfolio, it experienced a maximum drawdown of minus 19.47, whereas the buy and hold experienced a minus 54.21% drawdown. Significant difference between the level of drawdown, and that's bound to have some emotional response from all investors. So total returns, the timing-based strategy outperformed buy and hold, and in terms of drawdown or level of comfort, the timing-based strategy experienced minus 19.4, whereas buy and hold, huge drawdown of over 50%. Let's have a look at the next 3-year period. In a strong rising market from 2012 to 2015. You might remember these were the years of quantitative easing in the US. Once again, we can see the entry and exit signals over the 3-year time frame. These are the equity curves, once again starting with $100,000, and you can see the steady rise of the orange line, that is the buy and hold, with a few dips along the way. The blue line by comparison, which is the timing-based strategy, has several periods where the portfolio has been in cash. You can see that over the 3 years, there's quite a gap between the buy and hold performance and that of the timing-based strategy. In the first year, 2012 to 2015, returns in the timing-based strategy 15.03% and buy and hold 25.3%. In the second year, 2013 to 2014, timing-based strategy, growing the portfolio by only a small amount, 0.78%. The buy and hold strategy, putting on another 25%. In the final year of the 3 years, 2014 to 2015, similar performance metrics, timing putting on 4.58% and buy and hold 5.7%. So what does the 3-year picture look like? At the end of the 3 years, the total returns, timing had put on 20.31% and buy and hold 65.55%. In terms of the maximum drawdown, in this instance, timing actually produced a slightly larger maximum drawdown of minus 14.45 and buy and hold minus 10.11. So over this 3-year period, it was clear that buy and hold was the winner. In terms of maximum drawdown, buy and hold had a slightly lower maximum drawdown over that 3-year period. The next 3 years represents a strong, rising, but very volatile market from 2016 to 2019, and you can see the wide swings in the price of IJH over the 3-year time frame. Starting with $100,000, for a period of time you can see that the blue and orange lines initially are at least close together before they start to move further apart. In the first year, 2016 to 17, timing produced a 21.54% gain in the portfolio, buy and hold experiencing a little bit more than that at 31.01%. In the second year, buy and hold growing by 7.36%, whereas timing 2.85%. 2018 to 2019, timing grew the portfolio by 0.72%, buy and hold growing by 4.35%. So over that 3-year time frame, the total returns for timing were 23.3, whereas buy and hold 46.7. So buy and hold growing the portfolio twice as much as that of the timing strategy. In terms of maximum drawdowns, very similar in both cases. Timing with a maximum drawdown of minus 24.16 and buy and hold minus 23.14. So the clear winner in terms of total returns was buy and hold over that 3-year time frame. Maximum drawdowns quite similar. So what does the picture look like over the full 18.5-year period? So here we can see the difference in portfolio performance starting in 2000 with $100,000 and using a timing-based strategy and comparing it to that of a buy and hold. The blue line you can see significantly remaining flat during the GFC of 2008 and 2009. Some of the early outperformance of the timing-based strategy came in very, very handy when the portfolio went into cash during 2008 and 9. And once the market recovered, it did so from a much higher capital base. And that's one of the main reasons why you get such a divergence between the equity curves, is the impact of those bear markets when one portfolio sits in cash, whereas the other, being exposed to the market all the time, means that it's going to wear the full brunt of whatever returns the bear market provides. So what does it look like in figures? Well, over the 18.5-year time frame, the timing-based strategy put on 460.92%, nearly 100% more than the buy and hold at 463.49. So the timing-based strategy there, portfolio growing to close to $560,000, whereas the buy and hold strategy growing to $463,000. Over the same time frame, the maximum drawdown experience from the timing-based portfolio was only minus 24.16. However, the buy and hold maximum drawdown was minus 54.24. That largest drawdown from the buy and hold was experienced during the GFC, and the largest drawdown through the use of timing was actually experienced just prior to Christmas Eve of 2018. So in terms of total performance, the timing-based strategy wins. In terms of maximum drawdown, again, not surprisingly, the timing-based strategy also wins, ensuring that maximum drawdowns are lower than the buy and hold. So what are some of the key takeaway messages from this research? In rising markets, buy and hold generally wins, and we've seen that in more recent times. In falling markets, however, timing generally wins as the portfolio sits in cash while the buy and hold experiences the full brunt of any drawdown. Timing has the potential to outperform in sideways markets, and we saw that in the first 3-year period. And importantly, buy and hold experiences the largest of drawdowns. Over the longer term of 20 plus years, timing wins. And the reason timing wins is that it reduces those large drawdowns. So when the market recovers, it does so from a much higher capital base. And lastly, and equally importantly, is realizing that timing is a risk mitigation strategy. So what's the significance of all this? Well, when you're in retirement, it's a little known fact that for all the capital that's drawn down from your investments during that period, that 10% of it actually comes from the contributions that you made to your investment during your working life. And for most people, that's their superannuation contributions. 30% of the capital that's drawn down comes as a result of the investment earnings during their working life. But this is the kicker, because 60% of the capital drawn down comes from the investment earnings during actual retirement. And it's important to understand that if your nest egg is going to outlast you, that it's going to continue to need to produce earnings even whilst you're in retirement. So as an example, if you're 55 and you're watching this lesson at the moment, according to the American Actuarial Association, there's a good chance that if you're a female, you're going to last until you're 90 years old. For the fellas, it looks like you're going to last at least until 85. So that means you've got an investing time horizon or time frame of between 30 and 35 years. So if you were thinking that retirement at 65 was your investing horizon, you're actually quite wrong, because remembering you're going to need to continue to produce returns on your investment capital during retirement. Otherwise, you're going to outlast your nest egg, and that's going to result in a lack of choices and a very unhappy retirement. If you're 65 at this point in time, if you're 65 and a couple, then the good news is that there's nearly a 50% chance of one of you lasting until 95. Now, I'm not too sure which one that's going to be, but if you're 65, your investing time frame, if you're a female, is potentially another 25 years ahead of you. And for the men, another 20 years. So if you're in those age brackets, how should you approach the use of timing versus that of buy and hold? Keeping in mind with such a long time frame and the need to get growth, then the chances are that you're going to need to expose your capital to the market for longer than you thought. So how can we use a blended approach? That is, get the benefits out of a buy and hold strategy, but also access the benefits of a timing-based approach. We can do that quite simply through establishing a core and satellite structure and splitting the capital evenly across the two portfolios. As an example, in the core portfolio, we could have 50% of our capital, and in this case I've used $100,000, and we take one position in an ETF. The ETF of choice is IJH, the S&P Midcap 400. In terms of risk management, because it's using a buy and hold approach, there is no formal risk management. It's going to be 100% invested at all times. So that means when the market's performing strongly, this portfolio, the core portfolio, also going to perform very strongly. The second portfolio will be a satellite portfolio with the remaining 50%. In this case, the risk management is going to use timing. So that means that on occasions, it's going to be 100% invested in cash, typically during the larger market retracements. By structuring a portfolio in this particular manner, you get the full benefits of the buy and hold, that is, the growth aspects during a rising market, but you also get the protection of the satellite strategy using timing during those market drawdowns, during the big bear markets in particular. And also remembering that through using timing, there's going to be some periods in the market when timing actually outperforms that of buy and hold. So you get the added benefit there. So what does this mean in terms of risk management? Well, it's really all about finding your comfort zone. You might choose to mirror the example provided and allocate your capital 50-50 between the use of timing and that of buy and hold. You might choose a 60-40 split, 60% buy and hold and 40% timing, or you might switch it around and have 40% buy and hold, 60% timing. Could be a 70-30 split. Could be an 80-20 split. It could even be a 90-10 split. It's really going to depend on your level of comfort and sleep at night factor, remembering that you're going to experience in the next 10, 20 or 30 years a wide variety of market conditions. You might find that you experience periods 2, 3, 4, 5 years, in fact, of sideways moving markets in which a buy and hold strategy doesn't produce much in the way of gains. So therefore, that's when the use of timing can actually help to grow a portfolio. You might find that the next 5, 10, 15 years is very much an upward moving market, and buy and hold is going to produce the vast bulk of your gains. We might be on the cusp of GFC Mark II. At some stage in the next 10 years, 20 years, 30 years, we're going to experience GFC type conditions over and over again. So it gets back to your comfort level. Are you going to be able to sleep at night during these different market conditions? As markets recover and climb their walls of worry, are your portfolios going to be exposed so that they produce sufficient growth so that you have a long and prosperous and stress-free retirement? No matter what you choose, there's no right or wrong way to structure your portfolios so long as you have a sufficient sleep at night factor and are able to produce satisfactory returns so that your money doesn't run out before you do. That concludes this lesson on timing versus buy and hold. If you've got any questions, just shoot me a note at support@sharewellsystems.com. Bye for now.